Hello and welcome to the Invest with Rules midweek update. It is Wednesday, October 16th. Scott Bennett here with Mike Olafson. Mike, welcome.
Thank you. Great to be back.
What we're going to do very simply is cover the trend roadmap updates, the 2.0. We'll talk early results. We'll do a little bit of back testing going back to the 2020 COVID mess. We'll go to the 2008 mess and really just kind of helps me to compartmentalize just what we're doing, why we're doing it in regards to our trend and our signaling process. So before we dive in, obviously, world's quickest disclosure. This is just information, not a direct solicitation to go buy or sell anything. Please always manage your financial plan, your risk tolerance. You know the dance. All right. So when we're talking trend roadmap, just for a minute, I don't think we can put both our faces here. Very simply, there's four stages. This comes from a very simplified version from the great book from Stan Weinstein, How to Secrets for How to Profit in Bull and Bear Markets. And very simply, there's four stages. We use our proprietary, our trends and our signaling process, which are different than the stage analysis process. And very simply, what we're doing for short-term investors, we're kind of initiating positions potentially in either stage one or stage two, which we'll call U-turn or gas signals. And for longer term investors, very simply, what we're doing is we're trying to politely sit on really big winners. And how we're doing that is to have initiate positions in either U-turn or gas signals, and then ride through coast, ride through the trends, and then stage four break signals play a whole lot of defense. So very simply, what I want to do next is talk a little bit about some early results. So at the end of August, we implemented our updates for Trend Roadmap 2.0. And politely, we are always looking to improve, always looking to learn, whether it's daily, weekly, monthly, annually. And very simply, the sauce that gave us really great performance in the year 2022. The question is are those that defensive nature, is it worthy of investigating the trend roadmap and to say, is there a little bit of efficiencies we could do? And we found that there really were. And we adapt and we want to personally for ourselves, for our families, and for you to do well. So if we go over just very simply performance at a really high level. And obviously, past performance is never indicative of the future results. Please always think of all the massive disclosures in your mind. But so far, over the call it since the end of August till roughly today, in our newsletter and advisory practice, the advisory practice does have an advisory fee because we're doing that for people. And on top of that, we're doing really in-depth financial planning for people. But in general, we've seen almost a plus 1% alpha over the NASDAQ, almost 2% alpha over the S&P 500, and we're looking at almost 4% alpha or outperformance over a 60-40 mix dictated from the AOR. So in this little window of time, how is it doing so far? The answer is it's doing what we would expect. And so far, we're happy with results, but we're always pretty diligent. All right, Mike, I'm going to turn to you first. Thank you. And we're going to cover some back tests, but any comments so far, anything I've covered?
No, it's a great segue into the back testing. And I will kind of continue on that note where before we implemented 2.0, we did a ton of back testing going back 20 plus years to basically kick the tires and make sure that the engine worked, which you'll see the result of a couple of quick examples over the next few slides.
All right, so let's go to first, we're going to look at the 2020 COVID timeframe. So, Mike, why don't you talk us through a little of this kind of back test deep dive?
Yep. So this is the 2020 time period. This is January 1st to December 31st of 2020. I'm sure that we can all remember that year. We'll never forget it and what happened in our lives and what happened in the market. So this is taking the SPY, the ETF, the most recognized ETF for the S&P 500, and this is putting it through the trend roadmap using a short-term signal. In other words, buy on U-turn, sell on coast, meaning quicker trades in and out, trying to get in earlier and get out quickly before the actual break hits. And the results, what you could see in the chart, I know it's a bit of an eye chart, but I think that the chart itself in the middle of the page really tells the tale. The blue line is the how the SPY did using the Trend Roadmap 2.0 short-term signal, and the yellowish orange line shows buy and hold. If you just put your money in SPY and just let it run. And as you could see, and in fact, if you did that, you took a massive drawdown in the March timeframe as the COVID crash hit. But you'll notice how in the short-term signal chart, how not only did we avoid most of the carnage that occurred in March, you can kind of see, in fact, Scott, are you able to point to the screen? I don't know if that works. Yeah, that flat spot where that was cash. We were in cash during that time period, and then got back into the market pretty quickly and continued to outpace the buy and hold strategy for the rest of the year. And just some other quick stats before we go on and look at long term. You'll see the overall return was 24%. Max drawdown, which is very important to us, was 11%. And I don't know about you all, but 11% is very tolerable to me for my own money. And the total trades were 7 trades. So in other words, this performance for 2020 was achieved with 7 trades. Scott, any comments on that?
No, I would just say obviously we all want to do as well as we can, but the question is, can you sit through a really difficult downturn? And obviously,
Yep.
knowing the short-term trading signals trades more. So just knowing that kind of what to expect if you are using some of these signals and just kind of mentally compartmentalizing it through a really difficult environment. So we'll pivot to the short-term versus long-term now.
Yep. Oh, and by the way, I forgot to mention this back testing is courtesy of a great site called marketinout.com. We're not affiliated with them. We pay the full price for the service, but we really do love their back testing. It's very intuitive and produces great visuals, as you can see here. So speaking of which, this is the long-term back test where we're essentially, in this case, we're buying on gas. So we're waiting for that confirmation of gas. We're selling on break. And as you could see, the performance was pretty much dead on with the S&P, but or the buy and hold, I should say. But you'll see that long 2.5 month period of cash, sitting in cash, waiting for that long-term signal to kick in. And so you could see that you basically were protecting your capital during that period while the market sorted itself out, and the buy and hold folks were just holding their heads. The overall results, 16% return, 12% max drawdown, pretty darn close to the short-term one, with a total of 2 trades. Scott, anything and by the way, I should mention, in the lower left-hand corner, you'll see that when you combine up the 2 strategies for the total TR 2.0 performance was about 20.2%. So beating the S&P. Any comments or anything I left out there, Scott?
No, and I mean, as much as it's hard dealing with drawdowns, I think in reality, what we really want to do, and again, I'm speaking for myself a little bit, is when we're in a good trend, sit on your hands and just kind of sit back. Don't do much. But when there is a bear market or call it like a 36% drawdown, and how much can you really stomach? And is one able to click the button twice? And I think that's kind of the thesis. Obviously, when you combine short term and long term is what we do, we are looking for minimizing drawdown and maximizing growth. So what we're going to do next is kind of pivot to 2008, which to politely doesn't share a very pretty picture in any capacity. Buy and hold was horrific, down almost 50%. Our short-term signal, why don't we go into that next? So again, buy on U-turn, sell on coast, short-term signal.
Yep, yep. And like you said, it wasn't pretty. So we ended up basically the way I like to look at it, Scott, is we had a lot of at bats. We had a lot of signals hit during this year. And they were really false signals because we ended up, this strategy took a 30% decline, 13 trades, 31% drawdown. However, here's the key thing. Compared to buy and hold, it still beat buy and hold, as you can see from the chart. So the key is the short term was a lot of kind of tries, getting up to the plate and swinging, and strikeouts, but still protected capital better than buy and hold.
And again, this at bats would have been well better suited if what we do is we hedge. So in that
Yep,
capacity. So if we
spot
move
on.
to the long-term signal, so this wouldn't have tripped. So why don't we go into the long term next?
Yeah, and here's the fascinating thing with the long-term signal. you could see that cash would have been the name of the game for the majority of the year while the carnage was happening, except for 1 month, May. So 1 month, we got a long-term signal hit, ended up being a false signal, took a small loss, and then went back to cash. And to your point, Scott, this doesn't include hedging. So we could have been, just like we did in 2022, we would have been hedging, producing likely positive results. But the key is that the long-term trend kept us protected for the vast majority of the year.
And I'll chime in. So I was back then, I was working at Fidelity and I was face to face with really great families. And we were using we'll call it a modern portfolio theory, a little bit of stocks, a little bit of bonds, a little bit of cash. And what the system is designed to do when the market's imploding is you're trying to rebalance, but there's nothing to really rebalance. So what you're in essence doing is you're buying stocks as they're imploding, and then eventually you just kind of then sell stocks into bonds, and the stock market fell 50%. This combined trend roadmap 2.0 strategy would have been down about 16.5% when you use the short term and long term together like we do, and that doesn't include hedging. So the question is like, okay, well, imagine right now your nest egg. When you look at your financial screens, imagine it in half, or imagine it take a third off the table. That's kind of what most people dealt with. But the question is could you have stomached this process if there was hedging and you were down 16? If there's hedging, it would have been even less damage than negative 16 when a year when the market was down half. So I think that's kind of the way to think through this, is just what is your tolerance? What is your plan? Because we know, as much as you don't want to think about it, at some point this is probably going to happen again. You can't have exorbitant amount of leverage and debt in the system. At some point it comes to roost, and it usually sneaks up, but a trend system will pick it up at some point. So before we pivot to kind of today's live sheet, Mike, any final just kind of summarizations?
No, no, no. I think you said it well, and I think it really is a personal question for everybody. I'm about a half a generation older than you, Scott, a little bit different time in my life. And those massive drawdowns, like accumulation is pretty much behind me now. I'm now in preservation and spending mode. And so those drawdowns that like we're seeing on this buy and hold chart, just brutal, and I can't sustain them. There's no way I can.
Yeah, and I think that's as much as I'll do one more comment is everyone on Twitter got roughed up in 2022. But since the last 2 years, they've been doing really well. So they'll talk about and kind of give you this feeling of, are you keeping up with the Joneses? In reality, they lost probably because the NASDAQ got creamed, specifically more diversified tech stocks. So just think about that. They're not talking about anymore that they were down 60, 70, 80% in a lot of their tickers. And now they're like, I'm the king of the castle. But if you were to go over that time period, they got roughed up and they just
Yep.
don't want to talk about it. And I think that's really what long-term process is about. And that's what we're trying to accomplish for ourselves, for our families, and for you and for our clients. And I think we're again, Trend Roadmap 2.0, we're heading in the right direction. I'll stop there with we follow trends. This is our belief system. We'll stick to it. It's our process. We follow trends, we follow big money, we follow risk management rules. Thank you for your time today. If you have any questions, email us hello@investwithrules.com. It comes to myself and Mike. If you're like, this is totally cool, I want to know more, because in reality, I'd rather be traveling right now and not staring at my computer later this afternoon, then email us hello@iwradvisors.com. So, in general, very simply, we do not only trend following this process, but we also do very in-depth financial planning, because it's hard and we want to be a good ally and a kind of a good voice to help you overall with your financial situation. Mike, any final words before we wrap?
No, just thank you all very much. We look forward to helping you out and making this a profitable venture for you.
Yeah, thanks for being on the journey. Talk soon. Bye bye.